Hello and welcome to today's live webinar where we look at opportunities in review. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstance and realise that not all investments are appropriate for every individual. Moving straight into a graph of the Dow Jones. So the focus for today's recording, we're going to look at US equities, the watch list for the Dow Jones, the S&P 100. We'll look at the model portfolios and the performance of the stocks that have in the models currently and those that have been removed from the model. We'll then go through the recent US signals, and then we'll conclude with a review of the ASX signals and some of the stocks that we've been commenting on in the last week or two. So up on screen, graph of the Dow Jones. Now, for the most part, when you think about sort of the trend in the US market, we had sort of this peak period of optimism coming into the back half of 2017. And for the most part of this year, the US equity market has mostly traded sideways. So after a 10% correction, it's recovered about half of that and it's bumped along sideways. The shorter term analysis indicates that we've got a higher high and a higher low through this period. So just in reference to this 24,247 is at a higher low than that in early May there. And for the moment, the market on Friday night reversed off that support line and finished up near its highs. So we still give the uptrend the benefit of the doubt. But certainly in the weeks or months ahead, if we start to see the market roll over and take out this low, it's possible that much lower levels will be reached. But for the time being, we assume that the market continues to push a little bit higher. So to access the US equities, you click on your watch list, come in here, select Dow Jones 30, and we'll toggle through all 30 stocks, and I'll just share with you a little bit of analysis on each of these companies. Now, Apple's recent inclusion in Berkshire Hathaway's portfolio, so Warren Buffett's become a very substantial shareholder in Apple. Besides the fact that, terrific products, growing revenue, subscription-based service, the company is spending approximately $100 billion on share buybacks. And you see Warren Buffett is drawn to these type of companies. American Express is similar. But Apple is a combination of buying back its shares, increasing its dividends, and delivering roughly 10% earnings or revenue growth on the same time last year. We suspect that it continues to make higher highs and higher lows. And if you look at the algorithm signals here, we've gone from sell conditions in 2016 to buy conditions in mid-2017, and the stocks continued to make higher highs throughout that period. American Express, so this is a stock that Berkshire is a substantial shareholder in. American Express is spending significant amounts of money as well on share buybacks. So all else being equal, the company still manages to grow earnings just from the buying back and cancelling of the shares that are on issue. I think American Express is near the top end of its valuation range there, so I've put in the resistance, and it might be something that sort of once a month we just come back and revisit these American stocks and start to build a bit of a picture around which ones we're interested in adding into the portfolio. But American Express, top end of the valuation range there. Boeing being one of the best performers. Between Boeing and Caterpillar really helped to drive the Dow Jones index. And obviously the story for Boeing is increasing demand for their planes, in particular from Asia, as China expands the number of airports, and just emerging markets around the world continue to expand. So Boeing's been a beneficiary of that. Again, most of these Dow stocks all have fairly significant share buyback programs happening. The last signal we had in Boeing was on the sell-off earlier this year in March at around 310, and the stock's rallied since then. But again, very expensive from a PE standpoint at the moment. Caterpillar's been one of the better performing stocks in the US model portfolio, in particular the Dow 30 model. So it went from sell conditions in 2015 to buy conditions in early or mid 2016. That was at $70 a share, and the stock's now $150. From sort of that peak optimism that I spoke about in the back half of 2017, we've seen the stock consolidate and move sideways. Cisco Systems, so this was a darling of the tech bubble in 2000. They provide routers and switches for the internet, and they gradually moved more into services and software-based solutions, and that's helped to deliver the growth that the company's seen in the last sort of 5 or 6 years. So it's a slightly different business to what it was in 2000. Trades on a modest PE and a good dividend yield. And if we have a look at sort of the history of the signals here, it had gone from sell conditions into buy conditions in 2016. It was recently removed from the model, and then it was added back in there at around $42. Chevron, so interesting within these energy stocks. I think Chevron's probably the best technical pattern among them, and it had gone from sell conditions into a buy condition at around $100, now trading $124. Disney, so Disney is tied up with the acquisitions that are taking place. We've seen the approval of AT&T merger with Time Warner, and the prospect of, I think, Comcast making bids for Fox, Rupert Murdoch's assets of the Fox Group in the US, and Disney's in the mix wanting to compete for some of those assets. But Disney, for the most part, moves sideways here at around $100 a share for the last 2 or 3 years. But it is currently in the model portfolio and under buy conditions. Dow DuPont, I think this is the restructure of the Dow chemical business that late last year got taken over, and I think a component of it spun off and separated, and that's what we're looking at now. We've had an algorithm sell signal here at $70, so we're expecting that to have some downside pressure, and we'll continue to watch that. GE, so this was obviously one of the, I think it's the stock that's been in the Dow Jones the longest when you're looking at the components of the index today, but the company's had some issues. There's been a removal of the prior CEO, and there's a new CEO now in place, and he's taken some hard decisions to restructure GE, try to reduce the debt, and it's likely that a number of divisional sort of sales or spin-offs will help sort of see a leaner, meaner GE emerge over the next 12 to 24 months. But these big organizations, it's a slow turnaround. And if we have a look at sort of what's happening here, we've had an algorithm sell signal at around $20. We've had another one here at around $15. But I suspect that this is one that might be worth keeping an eye on over the next 12 months, as generally when you see sort of a new CEO come in, clear the decks, make the tough decisions, there might be a 6 or 12-month period of sort of restructuring pain, but ultimately you'd expect to see a better business emerge. So we'll be watching, very closely over the next 6 months just to see whether we do get the beginning of a higher low formation and an algorithm buy signal. What we're trying to do, I guess, in these next round of signals is trying to capture the stocks that end up embarking on sort of a 2, 3, 4 year bull market or increase in momentum, recognizing that some of the momentum stocks at the moment in the model portfolios are fairly mature in their trends. So it's a matter of thinking about, what are the next group of stocks over the next 3 to 5 years that are the ones to own. So we watch GE. It's under sell conditions, so it's not there at the moment, but let's come back and reconsider that. Goldman Sachs, so it's under buy conditions at the moment. The best way to think about Goldman Sachs is it's a very similar business to Macquarie Bank, and we've got a buy signal here. The stock's mostly sort of traded sideways, but it does look fairly bullish still with higher highs and higher lows, but you certainly want to see this support hold here at around $230. Home Depot been a great performer. It was went from sell conditions to buy conditions in the middle of last year at 145 and now trading 200 a share. IBM, so this was a stock that Warren Buffett cut from the Berkshire portfolio. I think they held it for probably, I think maybe it was something in the order of 1 to 2 years, but he made the tough decision to get rid of it, and he replaced it predominantly with Apple, which has proved to be a good outcome. So the issue with IBM is that some of its sort of older legacy style businesses have falling revenues, and they're trying to sort of switch to more cloud-based subscription based revenue, and they are doing that, but just managing those declining revenues in their older business models is weighing on the price. Intel, so that in generally, sort of globally, any of these chip companies have done extremely well, and Intel is probably the market leader in that regard. But it is under an algorithm sell signal at the moment, so not in the model. Johnson & Johnson's is in buy conditions, so we've had the switch from sell in 2015 to buy in early 2016. So it was added into the model at around $95, and the stock's now trading $120. And it's worth probably just keeping an eye on this. You would think that the stock finds support above this 110 level, so we'll watch that one in the months ahead. JP Morgan, interesting just to think about the comparison between the US banks and the Australian banks, where the Aussie banks are down anywhere from 30 to 40% from their highs, and then you've seen the strength here in JP Morgan, which is really a global leading bank franchise. So the US banks at the moment look like they're probably getting close to support, so we'll watch that over the weeks ahead. But currently the stock was added into the model portfolio in early 2017 at $85 a share, and it's now trading 107. Coca-Cola, we just had a sell signal on this on Friday night or late last week. So the stock was removed from the model after it being a position that was held for quite some time. McDonald's, so this was one of those stocks that performed really well over the last 24 months, and it's been a major contributor to the Dow Jones overall performance. But we have had the stock removed from the model portfolio, and it's under recent sell conditions there with the lower high formation. Just mindful that this low's taken out the prior one, and we've got another low in place. I've bumped the resistance there at 170, and we'd expect McDonald's to struggle underneath that price point. 3M, so this is a stock that's recently been added into the model portfolio, and we think they're at around $200 will be good support. Merck, so under sell conditions there at the moment, looks like the stock is just starting to roll over and make lower lows and lower highs. Microsoft, so again, this is probably one of the leading contributors to the strength in the Dow over the last couple of years. It was switched from sell conditions into buy conditions in early 2016, and the stock that was at around $47, and now the stock's at $100. So Microsoft have done a terrific job of integrating their product suite and sort of switching from the old application-based software into cloud subscription-based type services. Obviously, Microsoft also acquired LinkedIn. They own Skype. They own a number of other sort of businesses that are expanding out from maybe what you think about traditionally when you think about Microsoft. Nike has done extremely well, so it was added into the model portfolio in mid-2017 at $51 and continues to perform well. This will be an interesting one just to keep an eye on for the next algorithm buy signal. At some point over the next 6 to 12 months, you'll get a retracement, and we'll probably see another algorithm buy signal as a reminder to add that in. Pfizer switched from sell conditions to buy in late 2016 at around $30. The stock's now trading $36. Procter & Gamble, so this was removed from the model, so we had a sell signal in that late last week. Travelers Company, so this insurance company, it was added into the model portfolio a few months back, so in early May, at around this $125. The stock's been a strong performer there, and you can see mostly sort of higher highs and higher low formations. But at the moment there, it's been added into the model portfolio. United Health Group, this is probably one of the best performing stocks, I think, within the model. Certainly maybe within the Dow components. So in early 2013, it was added into the model portfolio at around $51 a share, or say $50 a share, and now trading $2.55. The most recent buy signal was at $1.30 back in September 2016. United Technologies Corporation, so again, this is a strong performer within the Dow. It switched from sell conditions into buy in early 2016, or in May 2016, and it's continued to make higher highs and higher lows, and the most recent buy signal was on this sell-off here, where we had the price spike lower, and a strong reversal there, and it was added back into the model. And we'll review the performance of some of these. Visa being a strong contributor to the Dow's performance. Verizon Communication, so interesting to stop and think about this in comparison to, say, Telstra, for example. Verizon has mostly traded sideways for the last 5 years, and that's fairly consistent when you look across most of the telecommunication companies in the US. They haven't delivered great earnings growth, but they've been fairly stable from a share price performance. So Verizon has just gone from sell conditions into a buy. So we'll watch this one with interest, as it's a fairly new addition to the model portfolio. And maybe with the activity that we've seen from AT&T, buying Time Warner, we seem to be maybe in the early stages of some sort of paradigm shift where these telecommunication companies are morphing into a stronger position within the overall media landscape. So it'll be interesting to see how that story plays out for Verizon. Walmart. So traditionally, Walmart has been beaten by Amazon, but over the last 2 years, Walmart has grown its online sales substantially. And, I think whereas you would probably normally think about Walmart as a old brick and mortar business, I think increasingly over the next 5 to 10 years, Walmart will be well positioned within the online space, as well as so becoming a genuine competitor to Amazon. The stock has made, so that the most part of this rally was driven off that success in the revenue and sales numbers coming from their online business, and we've had and I think it was just a case of, again, a little bit of peak optimism, the market getting too far ahead of itself. But I'm interested in looking at Walmart sort of between maybe this $75 level and $85 level. So it'll be interesting just to watch this and see how these algo signals play out over the months ahead. Exxon, I spoke earlier that I think the Chevron graph was probably one of the more bullish energy patterns that we're seeing, whereas ExxonMobil here, you can see it's got lower lows, lower highs, and the most recent signal was a sell there. And then there we are back to Apple. So that was the full Dow Jones 30. When you have time, you may wish to come into the watch list and just toggle through the S&P 100, which is the top 100 companies in America. Just to point something out if you're not aware, so the S&P 100 is made up of stocks that are listed on the NASDAQ and the New York Stock Exchange. So the extension at the end here, .NAS, means it's a NASDAQ listed, .NYS means it's New York listed. So you can toggle through those top 100 at some point. Okay, so let's go on to the model portfolio and have a look within the Dow Jones 30, which stocks are in the model at the moment. Now, the first thing that stands out when we load up this Dow Jones 30 is the increased number of holdings compared to, say, the ASX models. So currently the ASX 20, 50, 100 are carrying roughly 50% or slightly below 50% of the stocks that are in the model. So meaning that more than half the market at the moment is not displaying the positive momentum that's needed to have the stocks qualify to make them, to be a holding within the model. Whereas when we look at the US portfolios, that number's up at around 65 to 70% of the stocks are displaying that positive momentum that's needed. So when we look at the Dow, out of 30 companies, there's roughly 20 in the model portfolio at the moment. If we have a look at the percentage performance, so the worst performer is down, say, 9% versus the best performer, which is the United Health, which is up 382%. If we look at it from a days held point of view, the recent additions at the moment, Cisco was added only 20 days ago. It's up 2.98%. Travelers Insurance down 1.3%. I think Boeing there up 11%. So you can see the recent additions delivering sort of mixed results, but nothing too troubling there. But certainly over the longer term, some of these stocks within the Dow model portfolio have done very well. If we go down to the recent closed positions and we just have a look at the performance of the stocks that have recently been removed from the model, we can see there Coca-Cola delivered 11% return, Procter & Gamble, Merck delivered small losses, IBM delivered a small gain, Travelers Insurance was closed out for 4.7% gain. Cisco delivered 11%, and so on. So you can move through those. If we want to get a look at sort of a bigger picture of the US market, we'll go into the model portfolio of the S&P 100, and we can see here that the worst performing stocks are still only sort of moderate underperformers in comparison to the stocks that have done the best. And these are the current holdings in the S&P 100 model portfolio. So probably no surprise that Amazon, global leading company, if you look at it from, it was under algorithm sell signals in 2012, and then it was added to the model in late 2012 at around $200 a share, and it's continued to make higher highs and higher lows, and we haven't had a sell signal since then. The most recent buy signal was on the pullback here to around 1,300, but that's the best performing stock within the model. We go down to the next one, United Health. We looked at that. At this particular company, it's one of the names that are inside the Dow 30, so it was added to the model back here. Facebook, so it switched from sell conditions in 2013 to being added into the model in early 2014 at $54. And like Amazon, it's continued to make higher highs and higher lows and stays within the model portfolio. Netflix might be an interesting one. It's up 112. So let's have a look at the history here with this one. It was added into the model back in December 2017 at around $170, $180 a share, and it's continued to perform well since then. Something like FedEx, just to have a look at this. So again, it was under sell, so it was under buy sort of in 2010 through to 2015, moved into sell conditions, and then it was added back into the model at 156, and it continues to make higher highs and higher lows. So you can come in here and just have a look at some of these yourself. Let's just we've looked at them from a percentage gain standpoint, just look at from days held, so to see which stocks have most recently been added into the 100 model portfolio, and you can go through and get a closer look at those and have a think about sort of some of those names that if you're looking at building a US portfolio at the moment. Okay, so in addition to the S&P 100 model, there's also a model for the NASDAQ, so you may wish to take a look at that. Just to finish off here on the 100, so to come down and have a look at the recently closed positions. So you can see here the performance of some of these. So Texas Instruments was a great performer, and if we go back and have a look at the history of when that was added, so again, it went from sell conditions to buy conditions in 2013. and it was only recently removed from the model portfolio only a week or so back. And if we jump back into that, go down to the recent position. So that was what we're looking at there, Texas Instruments. So you may like to come in and just have a look at a bit of the history of some of these stocks that have been closed out from the model. So they're all your recently closed down the bottom. And then if you want to focus on what's been added to the portfolio, you would do that up here in the current open positions. All right, so now let's go to the recent signals which stores the last 7 days, and we'll just toggle through those, and then we'll move on to the ASX. So we come into the watch list, click on Recent Signals International, and you'll note that they're all sell signals at the moment. So let's move through these names and have a look at the type of chart patterns that we're seeing. So this particular stock here, lower lows, lower highs, and it's under a sell condition. Bed Bath & Beyond, same thing, downtrend under sell conditions. Discovery, it probably looks like it may be starting to break out, this particular name, but when it's not until we actually get that next higher low formation that we'd start to have a look at that. And it might be an interesting one just to think about in the next 6 or 12 months if we do see a buy signal on it, given sort of this shift that's happening within the media space at the moment. Expedia Group, so it looks like it's just rolling over after it being in buy conditions and performing well. We're just flagging there the lower high formation being removed from the model there. General Motors, so after it's switching from sort of sell conditions into buys, we've had a recent sort of alert here to the lower high, and we're just watching that relative to the prior peak there at around $46, just to see if General Motors runs into resistance at or near that sort of 43 to 45 level. Hasbro, which is making lower lows and lower highs, so just flagging that there at $90. Same here, so we have a pattern of lower lows and lower highs here. Coca-Cola, we covered that name, lower low, lower high, and it's been removed from the model portfolio. Mattel, same thing, clearly downtrend, a series of lower lows and lower highs. So some of these businesses that maybe have more traditional business models seem to be the names that are sort of popping up, these structural sort of weakness or the downtrends there. Oracle, lower low, they're at $50 a share. AT&T, so we spoke about this one acquiring Time Warner, and AT&T here at $33. It's under sell conditions. We would certainly watch this with interest over the next 6 to 12 months if we start to see a higher low and that buy signal appear there in AT&T. T-Mobile, so this is some of the other telecommunication companies in the US, but under sell conditions there as well. ExxonMobil, we looked at that, so that's lower low, lower high under sell conditions. And then there we are back. So that's, again, what we've done there is gone into the watch list, come down here, selected recent signals for international. And the point of interest here is that domestically, when you think about it, we're probably slightly ahead of the US market in the context of we've had quite a number of the stocks shift from buy conditions into sell conditions. Hence, we've only got less than 50% of the constituents that qualify that are actually in the model portfolios. We're probably just in the early stages now of seeing the beginning of that rotation in the US market, where we're starting to see an increase in the sell signals, which is something that I speak about in the top 50 recording this month, is just flagging that it's possible that we're starting to see some deterioration in the internal weakness of the indices, which is enough to make me a little bit cautious and having and thinking about how you manage portfolios in an environment where maybe equities don't remain as bullish as certainly what they have been over the last number of years. So that's the US wrap up of the US, and we'll start to revisit some of these names and have a look at some opportunities on the buy side of the market when they occur. Moving on to the ASX, so let's just go into the recent signals for the ASX, and we'll move through these fairly quickly, and then I'll just come back and summarize some of the names that we looked at in the last week or two within the ASX. So lower low, lower high there. Likewise, I've just put the resistance line in on these just to sort of flag that, you know, a lot of these are sell signals as well that we're seeing in the market. CSR was a buy signal, so it's a pretty wide range here, but I think the concern with CSR is the housing market seems to be slowing down a little at the moment. The stock has corrected from 590 down to 470, but I think you just need to be aware that we could see a slightly deeper pullback here on CSR. But I think the stock's well supported on a good dividend. There is an opportunity to sell covered calls over this name, so you maybe just want to keep that one on your watch list and just see, continue to watch these short-term momentum indicators and just see if there ends up being an opportunity to look at acquiring CSR within that range. So you might, if you're looking at adding it, you just don't want to be going in too heavy in the first allocation with a view that you may add to it at slightly lower levels. Buy signal here, not really a stock that I follow too closely. Sell signal. Iris, I think this on the short side might be worth just keeping an eye on. I think, you know, it looks like the stock's had a pretty serious sell-off through here, a little bit of a recovery, but I think it probably rolls over again, so that's one just to keep an eye on the short side. Netcom Wireless, not a stock that I follow closely, but just flagging that it's got a higher low there, maybe support at 112. If it broke below that, you'd be pretty cautious. Lower high there at around 90 cents. Higher low here at around 324. Super Retail Group, I'm a bit cautious on this. I think sort of the structure here looks to be mostly in a pattern of sort of lower lows and lower highs. So I think on this rebound, you're probably looking for this to run into resistance and move lower. And then there we are back to the beginning. So let's just revisit some of these names that we've commented on the blog and looked at in the prior recordings. So CIMIC Group, I think this is oversold here and we're expecting it to have a bounce. It does get tricky because the prospect of the actual overall market moving materially higher from where we are at the moment, I think is fairly limited. So you just don't have that tailwind that, you know, we enjoyed through the most part of last year. So I think these recoveries from oversold conditions are probably not going to be as aggressive as they have been in the past. But certainly CIMIC at these levels looks okay, and it's recovered its dividend quite quickly. It went ex-dividend last week, 75 cents, and it's already recovered that. And I think it can trade up to $45. But longer term, I think CIMIC can make a new high. I think fundamentally the support that from infrastructure spend coming through continues to be a bullish catalyst for CIMIC Group. So eventually looking for it to make a new high. Santos, so oil prices were hit pretty hard on Friday night, but I think Santos seems to have held up reasonably well. It was switched from sell conditions into buy signals here at sort of 470. They've had the takeover offer at $7 that they've knocked back, and we're thinking that this 580 level holds and Santos trades higher. Tabcorp, I've been chatting about this one on the blog for a while. We like this name coming into the August earnings result. We think the cost synergies from Tats Group underwrite some of the downside risk. So looking for that to move higher. Origin Energy, I think on this weakness in energy prices that we're seeing at the moment, you want to keep this one on the radar. I think Origin can probably trade up to 10.50. they should reinstate the dividend in the August earnings result. So we like Origin and keen to add it on any material pullback that we have. CYB. This is Clydesdale. This is the old spin-off from NAB. They're looking at merging with Virgin Money or acquiring Virgin Money. I think we're only about a week out from them having to make an official offer for Virgin, and it sounds like it'll be a good acquisition. And in that environment, I think maybe CYB could trade up and possibly fill this price gap here up to around 580. So that's one that we're looking at. SGR, Star Entertainment, looks to be oversold down here at around 480, 490. So we continue to track that. And then if we just jump into the Aussie market, let's just have a quick look at, so the banking stocks in general, I think you're getting a little bit of short covering rally at the moment, but it's hard to see whether fundamentals change to support higher share prices for the bank. So I think, any short cover rally that we experience is probably an opportunity, to lighten up on the banks over the coming, weeks or months, depending on, how far those trends evolve. The resources at the moment are under pressure following energy prices being down on Friday night, but I think it's a buy on the dip story for BHP and Santos and Origin. So that's the theme that we're watching for. Interesting at the moment, even though US raised interest rates 25 basis points, the bond market in the US has eased back, which has allowed the interest rate sensitive names to rally. So things like Transurban, Sydney airports, some of the property trusts have actually done quite well, but we do have sell signals in those names. So they're now back up sort of against that resistance level. And part of the attraction, I think, with Transurban here is obviously that we're coming into them paying dividends in another week or two. So the market just positioning in Sydney and Transurban ahead of those dividends. And if we have a look at the top 50 and just what's moving here, the same pattern there within the resources being a little bit weaker. Red sort of the number of analysts of upgrading Brambles, but still we don't really get excited about that name. Don't see too much growth there at the moment. Celtx, we've been commenting on that on the blog at around $29. That was good value. We had a $32 price target there, looking for it to move back up towards those levels. Insurance Australia Group was another one that I spoke about, just saying that we don't get these corrections lower very often. In IAG, it's a very good business. One of the only stocks, I think the only stock that Warren Buffett's ever invested in here in Australia. And below $8 is good buying. It is expensive, so I think in the case of owning this, you want to be selling sort of $8.50 covered calls and stripping out the upcoming dividend and collecting the call option income. Ramsey Healthcare, so it's algorithm sell signal, so I think at around $60, $61 it runs into resistance again. So that was one that we've commented on the blog. So it's a bit of a sort of counter trend move here. The stock probably just got a little bit oversold there at the moment, but I think you want to be thinking about taking profit in this name if you've set positions in it at around this $61 level. Longer term, we look for it to build a higher high and a higher low, and it'll be added into the model. But at the moment, we still see this as sort of a little bit more of a counter trend, a move from oversold conditions. So AGL, part of that sort of yield sensitive basket that's actually held up quite well. I think Wesfarmers is getting expensive, and there's so that's a summary of where we're at. So thank you for listening in. I hope you enjoyed the coverage of the US Dow Jones and the S&P 100. And if you'd like to have a chat with me about international equities or just US equities specifically, please don't hesitate to call the office or send an email.